Wow, what a day. October 1st starts MLB playoffs. Go Tigers. Had a really cool Lions win last night. And most importantly, this starts my 30th year as a mortgage lender. Kind of cool things happening. Once again, it's Scott Riley at the market update desk, NMLS number 157524. Let's go through what's going on today. We got the start of some jobs information. Um, let's kind of break everything down here. So stocks and bonds are higher. I'm sorry, stocks are lower and mortgage bonds are higher so far this morning. Now that's on the heels of a potential imminent strike from Iran on Israel. And this could cause a significant flight to safety from equities into the bond market. So we might see a little bit of a improvement to rates from that. Domestically, the International Longshoremen's Association, the ILA, strike went into effect last night. It looks like the current administration is trying to see how things are going to go, quote, closely monitoring negotiations. It does appear the White House is not concerned yet with the strike, but that is in stark contrast to what the president of the ILA, Harold Daggett, said recently, where he explained that the impact and how it would cause loss of jobs would cripple the U.S. economy. So it does seem like we definitely have two different sides that are not close together so far. JOLTS, the job opening labor turnover survey, started the jobs week data, and that showed job openings rose an unexpected 300,000 from 7.7 million to 8 million, which was better than the estimates. Now, while this headline is a little stronger than expected, we do have to understand and watch that there's a lot of double counting with jobs working from home, different job titles that are encompassed within this report. The hiring rate, a very important factor in this report, fell from 3.5% to 3.3% and is at its lowest level since 2013 when you take out COVID. And honestly, it's not far from the COVID low of 3.1%. The quit rate fell from 2% to 1.9% and continues to decline. Now, this is the lowest level since 15 when you remove COVID, and it shows that the weakness in the labor market is continuing as the lower quit rate means fewer and fewer people are confident about leaving their old job and finding a new one, and job poachers are having not as much success because people are concerned about moving jobs. Bottom line, well, this is the first of the jobs data this week. It does show further weakness within the hiring and the quits rate. When we see job openings drop this much, there is a concern definitely within the jobs component of the economy. Chair Powell spoke again today, and he showed that he was more optimistic in his tone on the economy and the labor market. So this did pressure bonds lower yesterday afternoon. Compared to his speech 2 weeks ago after the Fed 18th meeting, he had more confidence on the economy being strong and a strong labor market. He did believe that with an appropriate recalibration of fiscal policy stance, strength in the labor market can be maintained in an environment of moderate economic growth. Very interesting that he indicated moderate economic growth, and inflation moving substantially down to their objective goal of 2%. He also explained that overall the economy is in solid shape and the Fed intends to use their tools to keep it there. Lastly, what he mentioned was that the Fed plans to stay the course with another 0.5 point cuts in total for the end of the year, which would mean most likely a 0.25 point cut in November, 0.25 point cut in December. Now, the market had been increasing its chances and expectations of another 0.5 point cut in the November meeting. So this could have caused some of yesterday's sell-off. Fed futures, though, still doesn't quite believe Powell in that they're only going to do a 0.25 point because there's still a 40% betting chance of a 50% 50 basis point cut in the November meeting. The last big item was the ISM Manufacturing Index. This showed weakness continues in the manufacturing sector. So the manufacturing index in September remained in contraction, sub 50. That came in at 47.2. The employment component fell from 46 to 43.9, which is deeply in contraction. The prices paid, which is an inflationary measure, made the biggest decline and fell almost 6 points to 48.3. This is the first reading in contraction for the component since last December, and bonds rallied this morning and kind of clawed back some of the losses from yesterday. So we've been bouncing between some resistance levels on the 10-year bond. We've been trying to get it back under 4.7. We previously had been hovering Friday and Monday around 3.77, trying to get that back under 3.7. Mortgage-backed securities have been bouncing off their 25-day moving average. So we're seeing, maybe we can get that moving back upward, get back, a little closer to the rates maybe that we had last week. We'll keep you up to date as tomorrow is ADP payroll. That's going to be a big, important number. And then Friday, remember, is the BLS jobs report. Looking forward to analyzing those numbers, getting them out to you. Feel free to give us a call. We'll help you get pre-approved, help get your offers accepted. In fact, we just got an offer accepted a couple nights ago on the strength of our knowledge, helping our buyer be in a better position to negotiate. 616-293-2189. The Market Update Desk. Follow us on all the socials. Your original singular market news source for West Michigan. Have a great afternoon.